Hello, welcome. Investing in the stock market has many challenges. So in today's video, I hope to provide a tried and tested method that I and other professional traders and investors use to increase their chances of making more profitable investments over time. So that's the summary. Let's get into it. Step 1, decide on your time frame. As I've mentioned in earlier videos, you must decide on your time frame. In short, you need to decide whether your trade is for a few days or potentially for a few years, as this is really the foundation for the future steps in my method. That said, there are two parts to time frame. First, the bigger picture. Decide your time frame for your money. Do you need to buy a car or have a serving of avocado toast or go on a vacation or anything else? That determines the time frame for your capital. Second is the specific time frame for this investment and ties into the next step. Step 2. Pick your method. The most common two methods are technical analysis, reading the stock charts, using indicators like support and resistance levels, and fundamental analysis, understanding the financial health and growth prospects of the company. My preference is to use a blended method. So I start with a fundamental case and then layer over technical analysis on top. Choosing your method ties into your time frame. Typically a longer time frame has a much more fundamental case, and a shorter time frame has a much more technical analysis case. This is why I like stacking both methods. So I hopefully get a reasonable short-term timing and then have a solid fundamental investment case behind it. There will be more in-depth videos to come on building a fundamental case and also on technical analysis. So please subscribe to know when I've posted those. Step 3, build your thesis. The best way to explain this is with a basic example. Say Disney stock. We all know Walt Disney, currently undergoing a fundamental turnaround with their great CEO Bob Iger back at the top. It just started to show profit in their streaming division in the last earnings last week, a quarter earlier than expected, which many have been waiting for as a sign of strength. Plus they just raised their prices on their streaming, so that should also lead to future profit in that division. So you wrap all of that up and you have a bit of fundamental basis being shown in at least one of their three main divisions. Then if you layer in the stock, you can clearly see there is a very strong range-bound history, nearly 10 years, with a very strong low support level around $80, which has been hit and provided support multiple times, which makes it a stronger support level, and a higher resistance level of around $120, which has also been resistance multiple times, making it a stronger resistance. So aside from the post-COVID breakout, up to $200, you have a pretty solid range with strong support and resistance levels. So now you have a combined thesis. Step 4, decide on your conviction level. How confident are you in your thesis? Is it a high conviction, meaning you want to build a big position? Or is it low conviction, so a smaller position? The example I've laid out is good, but not thorough, as Disney has two other key divisions which I have not mentioned. And one was showing weaker outlook last week, their theme parks. So we've not really taken a view of the entire fundamental story, nor have we factored in the global consumer, which is showing signs of weakness. So overall, I'd say low conviction on the fundamental case, without further analysis anyway, but much higher conviction in terms of the technical levels because they've been hit multiple times and sustained for a long time period. So the key for this step is to decide how big will your position be in your portfolio. Small, big, or medium. Say, just for example's sake, a small could be half the size of medium and big could be double the size of medium. Step 5, cross-check the street. This means what is Wall Street and other professionals saying about your thesis. This will let you know if everyone is already behind your trade and agreeing or not agreeing with your idea. You do not necessarily need them to agree up front, because having them come and agree after you've already started can add the momentum you need to get it moving. That said, having them agree before you start your trade, especially when you're early to investing, is probably a more beneficial approach because it confirms your thesis is in line with what the pros are thinking, and it's quite reassuring when you start. Step 6, check the market. Where is the overall market trading? Are we at all-time highs? What is the trend? Where is the momentum? Are we slowly climbing higher? Or are things a bit more volatile? The famous phrase is bulls or buyers go up the stairs and bears or sellers jump out the window. So timing the market is never easy, as I mentioned in my last video, as nobody really has the magical crystal ball to see the future. but having a view or an idea of where the market is and what is the current market sentiment is important. Now, pro tip, the VIX. It's worth mentioning here. What is the VIX? The VIX is widely considered the main fear gauge of the stock market. What does this mean? For every 16 points on the VIX, meaning 16 points of volatility or vol, you can expect around 1% volatility in the market, meaning a movement up and down every day of about 1%. That's considered average or normal. But you can see last week on the chart I've put up, when the yen carry trade unwind news sort of exploded onto the scene and the Nikkei smashed down 13% in one day and then turned around and rallied 11% the following day, shaking global markets, fueling fears of a US hard landing or recession. The VIX exploded from sub 16 to around 65. So what does that mean? It means that it was expecting less than 1% movement per day, and it changed to now expecting around 4% daily volatility in the entire market. That's quite significant. As it turns out, fears were overblown. The majority of the yen carry trade had been largely unwound. Supposedly the market's saying at least 75% of that's been unwound. So the VIX is back to around 21. So a little over 1% of volatility expected in the S&P now after that sort of very shaky last week. So we're in a slightly more volatile and unstable market environment compared to a week ago. Step 7, check the calendar. When is earnings or the next stock-specific piece of data due to be released? So companies typically have 4 earnings cycles or earnings quarters through the year, meaning every 3 months they make a public announcement explaining their financial performance for that prior quarter, the current financial health of the company, and their outlook for the coming quarters ahead. So throughout the year, you have these 4 earnings cycles, which occur a couple of weeks after each earnings period. So that means roughly around late January for the December quarter, around late April for the March quarter, and around late July for the June quarter, or now, obviously, August. It continues for about 4 to 6 weeks, and late October for the September quarter. So it's also worth knowing not just the company-specific calendar, but also the market calendar. So is there any specific economic data which may affect the entire market or your stock in particular? Inflation data is very hot at the moment, as that's leading into the Fed's decision on whether they raise or reduce interest rates, or the central bank making interest rate decisions. We've also got retail sales data, which is in the same theme, showing what consumer sentiment is. And finally, the major one, which is also new job creation data, which is also what we had last week. We had much weaker US new jobs being created compared to expectation. Now, pro tip, the 3-day rule. Most pros follow a 3-day rule around earnings. What does that mean? It's based on the theory that it takes typically around 3 days for the big asset managers and pension funds, often called the smart money or long only money, to sort of digest all of that information which is released in an earnings quarter, and then sort of begin unwinding their existing positions or adding to or creating new positions. So they have all the news come out, they digest it for a few days, and then they begin to make those trades. So in those 3 days, you get much more volatility as the real trend is being developed. So the greatest risk for smaller investors is investing in those 3 days. And it's therefore often better to wait for those 3 days to pass and the real trend to be established to see where the smart money or the long only money is going, and therefore jump on that momentum. That being said, you can also obviously get much better bargains or potentially lose your shirt by investing in that 3-day period. Step 8, building your position. Most traders and investors don't buy all at once. They often use the rule of thirds. So what's the rule of thirds? Once they establish they want to begin building a position, they start with 1/3 of their planned position size straight away. So they just get started, put something in, $1,000, whatever. Then they wait based on how the stock and the overall market actually trades. Have I timed it right? Is the market up and down? Potentially adding that same day or potentially over many weeks to come. Of course, it really depends on your overall time frame and your actual thesis. So just know you do not need to put everything in all at once, and the pros rarely do. They always have some extra cash ready to go to help improve their entry price or perhaps follow the momentum and increase their position. Bonus tip, order types. You need to understand the main trade order types. Limit orders are your friend. This is compared to a market order. A market order means you buy or sell your position value, say $1,000, regardless of the price, meaning just buy it now, $1,000, fill, even if that means the price moves. Whereas a limit order will not start trading unless the limit that you set, the price that you set, is achieved, and the order will remain in the market until your position size is filled at or better than your limit price. Finally, also worth mentioning, a stop loss order that some traders use. This is an order that sits waiting in the market at a set level, and once reached then becomes a market order to close some or all of your position, to limit your risk. For example, you buy Disney stock at this support level that we've found at $80. You then set a stop loss order at $72, which is 10% below the support level and also the entry price that we've chosen. So now if Disney trades down to $72 on some market event or stock specific news, then your stop loss order instantly becomes alive and will become a market order and close your position, locking in your loss at around the 10%, pending of course how fast your order can be filled. It's not precise, depending if it's a large order. Now, pro tip, trading outside market hours. Some brokers, including interactive brokers, which is the low-cost broker I prefer, allow you to trade outside market hours. Now, just like the 3-day rule, be aware, trading outside of market hours is often much more volatile because there's much fewer market participants trading during that time, so much less volume, so you get bigger price fluctuations. Plus, earnings and other events, economic data, etc., is often released outside market hours to limit the impact or that volatile swing. So if you're trading during that period, then you're more likely to, see that volatility. This means you get a greater chance of finding a bargain, well done, or losing your shirt because you've entered at the wrong price. Finally, step 9, take your profits. This is a key step in the method that many new investors fail to take seriously. You have designed your thesis. You have your method. Well done you. It's worked. Disney is now trading at $120, which was your target when you started. Now what do? It's going to the moon. Diamond hands, as they call it. Hold it forever. You're going to strike it rich because now maybe Disney's going to be $200 or $2,000. Well, maybe. Obviously, nobody knows, but most likely not. This is not how disciplined, high probability trading and investing works. You have your thesis and you stick to it. Unless, of course, something material has changed during your time frame to make you change your thesis. Otherwise, you take your profits. You pat yourself on the back and you find your next investment so you can send your little money soldiers to go back out to work for you. So that's it. You now have a professional method for investing. Well done you for watching to the end. It's worth adding, the whole point of my channel is to teach and demystify the complicated world of investing and money. Sadly, once adding a little complexity like this method, it's easy to get overwhelmed. So please remember what I emphasized in my last video. Time in the market is more important than time in the market, and no method is foolproof. So please do not get overwhelmed with the details when you're starting out and put your head in the sand and just do nothing. Often the simplest method of buying an S&P index tracker and investing regularly in that, maybe even adding more on market drawdowns like last week, is still often the best low risk, low stress, low complexity growth strategy for the majority of investors, and probably a great way to start. So I wish you all well. Thanks so much for watching to the end. I hope you found today's content interesting. So hopefully you've already subscribed and liked, as I have many more videos to come.